Hello everybody, welcome to Alpha Action. Today we're going to be going over the top 5 dividend stocks. So the first one that comes to mind for me is DTE. It's a utilities company in the greater Detroit area. It only has a price to earnings ratio of 13. It has a moat because DTE has 0 competitors in the area, is defensive, has a cash dividend yield of 5%, has high margins, debt to equity of 1.3, payout ratio of 60%. The reason that even though it has a PE ratio of 13, so that would mean that at 0 growth, you're still going to be making like 8% a year. It's defensive and it has high margins. And so on top of that, you have the moat that it also has. This makes it a very high quality name, and so it might be a bit pricey at a PE of 13 because if you're doing deep value investing, you always want a low PE. Mostly when you're doing deep value investing, you look for PEs down at 5 or 6. But DTE, I'm giving that an exception because of how risk-free I consider DTE to be, due to the lack of competitors, due to the defensiveness of the utility sector, and the fact that it has high margins. And those all work in its favor, and those all say that the cash flows are very risk-free. Another one is GOLD. GOLD is the ticker symbol for Barrick's Gold. Gold and silver producer, it's trading at a PE of only 7, debt to equity ratio 0.17. And so first off, just looking at this, trading very cheaply, yet it doesn't use a lot of debt. And with current monetary policy, gold and silver actually look really attractive. I can get into that in another video. Cash dividend yield of 1%. That's not a lot, but the payout ratio is only 6%, and it plans to triple its dividend every year. It's a high grower and has 400% annual growth in free cash flows. It already had that last year, but now it's expecting that again this year. And Barrick's Gold was just last year completely unprofitable. Then the quarter after that, earnings went to like 6 cents a share, then 11 cents a share, then they jumped up to $2 a share. It's a very quick grower. And the fact that you can see a quick grower for a PE of just 7 is absolutely crazy. Usually you see that there's something for a large value that might have PE of 7, but it doesn't have very much growth, or the other way around where there's a lot of growth, but the PE is all the way up in 20, 25, 30, etc. Over here, you're seeing PEs very low, yet there's high growth, doesn't have a lot of risk to cash flows. I don't see why not. And on top of that, it's counter-cyclical. So if you want to hedge your portfolio, everything else in your portfolio might be cyclical. So if you have Apple, Microsoft, other types of names in your portfolio, you want something counter-cyclical in your portfolio that makes money when the rest of the market goes down, here you go. You got gold. And so GOLD, that is Barrick's Gold right there. I'd say that out of all the picks, this is the best. Next, we have Newmont Mining, NEM. Again, gold and silver producer. I would say this one is a bit safer than the last one, but I think both of them are quite safe. This one is a tad bit safer than the last one just due to the fact that it has high margins. It's trading for a PE of 11, debt to equity ratio of 0.3. Again, silver and gold, they look very attractive right here. I can make a later video on why they look very attractive with the current monetary policy. Cash dividend yield of 2%. It plans to quadruple its dividend. It's counter-cyclical again, so you can hedge against all your other more cyclical names in your portfolios. I've noticed that the people that are subscribed to this channel tend to have a lot of tech stocks in their portfolio. This goes up when those go down. This goes up in a recession. These are counter-cyclical right here, so this is what you need to have. As a payout ratio of 11%, again, very low payout ratio, high margins. This, I would say, out of all of the names that I'm mentioning today, Newmont Mining is the safest out of everything. Even when gold went down to lows of 1,050, Newmont was still profitable. It was doing very well, still at high margins even there. And so I just see no reason to say that this is risky. This is one of the safest ones out there. Barrick's Gold, I do think you will see more of a reward, but you do see a bit more risk. But overall, all of these picks right here have very little risk, lots of reward. But I think out of all of them, this is the least risk. This is the least risky, I can say. This has very, very little risk. I don't see how you can lose out on Newmont Mining. Next, we have VEDL. This is Vedanta Limited. It's a diversified metals miner in India. It has a PE ratio of 3.5, payout ratio of 27%, cash dividend yield at 8%. And here's the next reason, and this is the reason that started to go down initially over the last couple of months, but this is why I want to be buying the dip. It benefits from a weak dollar. And so as the dollar consistently goes down against the INR, so you have the USD and the INR. The INR is the Indian rupee, the USD is the US dollar. What's happened over the last year is that the reason this thing has gone down quite a lot is because the dollar has strengthened against the Indian rupee, but I expect the opposite to start happening due to the fact that there's so much quantitative easing, debt monetization, raising of the balance sheet, lowering of rates, etc. going on. And so I expect a weaker dollar. And a weaker dollar will make the Indian rupee stronger against it. And so this diversified metals miner will now make more money. And it has a debt to equity ratio of 0.36. So from debt to equity perspective, it's safe there too. But this one, I say is more risky, but the potential is ginormous. I mean, with a PE of just 3.5, you're making returns of basically 50% a year is possible. You could see returns of 50% a year with VEDL, Vedanta Limited. And also, this is the inflationary hedge. And so, if you have a lot in your portfolio, if you have bonds in your portfolio, for example, bonds do bad when there's high inflation. And if you go into an inflationary recession, your stocks won't do good, your bonds won't do good, you need a hedge. VEDL is your hedge if the dollar goes down and the rupee goes up. And so if you're not noticing already, I'm naming off defensive names, I'm naming off counter-cyclicals, I'm naming off names that are going to make money in times of high inflation, because I understand that most investors are all in the market and that they've lost a lot of money in the last couple of weeks because they've all been in cyclical names like these tech growth stocks like Apple or Microsoft and such, which I'm not completely against. You can go and put your money there, but you should hedge it with one of these names right here. Next, we have CVX. So oil producer PE is 45. Now, before you tell me the PE is really high, the PE ratio is a little off due to a one-off quarterly earnings, but if we discount last quarter's earnings, the PE is only 10. And so that accounts for why the PE is really high, because most of you know, people that have been around long enough on this channel know that I am deep value, that I do not buy anything. I'm not a growth type person really, unless the growth comes in with value, but I really don't buy anything with the PE higher than 15. That's just a big no-no for me. And it might, for you, you might be more of a growth person, so you don't care if the company right now isn't earning money or if it has a very high PE ratio. But for me, I'm a value person, and so with deep value, we like to look for very low PE ratios. And so discounting last quarter's one-off earnings, the PE is only 10. Oil is expected to go higher in the long term. I think in the short term, though, it is headed a bit lower. From the way the technicals look, but from the way the fundamentals look, oil in the long term is headed higher. And here's the reason why. The oil companies, with oil so low, the oil companies that have a lot of debt, these penny stocks that you see out there that have a lot of debt, they went down like 90% in one day as soon as it was announced that that Russia was raising supply and Saudi Arabia was raising supply of oil. Those companies will go bankrupt. And so now there will be a supply shock where before the market was very worried about a high supply of oil, which it still is. But then as those U.S. shale companies start going bankrupt or they stop drilling and they start liquidating themselves, then there will now be a lower supply of oil. And so the oil price will go up, and coronavirus is temporary, so oil price will go up because of that in the long term. Again, if there's a weak dollar, oil price will also go up since the dollar is measured, or since oil is measured against the petrodollar, which is really just the word for saying the US dollar for trading petroleum. Debt to equity ratio 0.2, very safe. High margins, even with oil this low, they're still producing. They can produce down to $15 a barrel, which is the cheapest in all of the United States, cheaper than ExxonMobil or any of the others, cheaper than British Petroleum, that's BP, cheaper than Royal Dutch Shell. The only ones that they're behind are Saudi Aramco, but that's trading way too expensive for me, has too much risk, and the Russian players out there. But excluding Russia and Saudi Arabia, They basically produce oil cheaper than anybody else in the world. They can produce it for $15 a barrel if they wanted. Oil could go a lot lower, and Chevron will still keep on doing good. Has a cash dividend yield of 7.4% and a payout ratio of 0.75. Okay, so those are the 5 picks right there. If you really like this, like, comment, and subscribe. We have daily videos right here. All levels of content from beginner info like this to more advanced videos. So if you're looking for some beginner info and you're just getting started, we have simple videos like this where we just go through simple dividend stocks. Or we have advanced videos. If you're saying, I really like this, but at the same time want some more advanced, we have advanced videos with things like CFDs, spread betting, option spreads, future spreads. You could even start getting into intermarket trading, all those sorts of things. We have those every day. So it doesn't matter where your pay grade is, whether you're just a beginner and you're just starting off. And so you're starting off with a lower level video like this, which I hope that you're going to watch this video and eventually start looking at the more advanced videos where we go over more advanced concepts. And so we have videos all over the spectrum. Doesn't matter if you're just getting started or if you've been doing this for decades. We have videos all over the spectrum. And I will soon have a video titled How to Start an Options Income Portfolio with Just $3,000 Revealed. And so if you're really looking for the income, sure, dividends might give you 15% a year. Really, if you're really looking hard, you might get 10, maybe 15% a year max, in a safe way. But if you're really looking for a lot of income, I will have a video called How to Start a Options Income Portfolio with Just $3,000 Revealed, and that will be released soon. And so if you really want more income and you're not just looking for dividends that might pay you 10% a year, but you're actually looking for income of 40, 50% a year or even greater than that, many options traders out there who trade non-directionally, spread trading, they make 100, 120, 140% a year. Directional traders trading naked and building into vertical spreads can usually make, I would say, 200 to 300% a year. Many traders out there make even more than that, though. It's definitely possible to do that. It takes a lot of work, though, but I will make a video on how to start an options income portfolio with just $3,000. And over there, you can probably expect a return of 50 or 60% a year. So obviously, it's not like the 400% that many traders make. It takes a lot of work to get to that point, but it's definitely better than just dividend stocks. So if you're really interested in income, then watch out for that video, subscribe. I will be making a video on how to start a options income portfolio with just $3,000, and that will be released soon. And you can make quite a lot of income with that if that's what you're looking for, and make it consistently, which is another great thing. All questions and comments are going to be answered. Just go down in the comment section if you don't understand something. If you have a question, it can be as simple as, it could be a simple beginner question like, what in the world is a dividend? It can be a question like, what is a CFD, or what is spread betting? What is option spreads? What are future spreads? What is an options income portfolio? How much money do I need to do something? Whatever it may be. If you're trying to ask about brokerage accounts, you're like, hey, what's the difference between Reg T margin and span margin? All of these different things. We answer every question out there, whatever the question is. Doesn't matter if it's a beginner question, if it's the expert type question that's higher level. Doesn't matter what it is. We answer all questions. If you disagree with anything or you have constructive criticism or just any comments, we answer those too. So go down in the comment section. Please drop a comment. And if you like this video, please drop a comment too, because the more comments you guys drop, the more the YouTube algorithm picks up on it, and the more this video gets recommended to others. So, thanks for watching, and until then, happy investing.